Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Back in March, SPAR hosted a Capital Markets Day. They promised that a strategy review of the European businesses would then be completed by June. They noted that their guiding principle for this analysis was that return on invested capital, or ROIC, would need to be ahead of the weighted average cost of capital, or WACC. Now, these are very technical terms, and those who studied finance will recognize them. It basically means that SPAR has recognized the need to generate economic profits, which simply means returns ahead of what the underlying risk in the business would require in terms of what it needs to generate to give shareholders a fair return. Now, this concept isn't nearly as familiar in the retail sector as you might hope. There are far too many retailers who focus on stuff like trading space growth, gross margin, and operating margin, without including metrics like working capital ratios and return on assets. It's shocking that the balance sheet doesn't feature enough in these metrics, but sadly, this is what happens. To see SPAR put such an objective lens on the analysis was therefore encouraging. At the time of the Capital Markets Day, they indicated that their review was focused on the UK and Switzerland. Fast forward to June, and SPAR kept their promise. They have completed the European strategic review, and they've decided to sell both those businesses. This is an encouraging step, and it's certainly better than the approach that they took in Poland, where good money was thrown after bad. Yes, it's easy to say this stuff from the outside, and they were severely hurt by the pandemic, which was obviously a shock to the entire world. But accountability has to sit somewhere, and that is why execs get paid a ton of money. With new management in place, the carcass of Poland has now been dragged away, and SPAR effectively paid for it to go away, I might add. Instead of waiting for things to get as bad as that in Switzerland and England, they are now looking to sell those businesses while they still have value. Good. But what does this leave them with? Who Moved My Cheese was first published in 1998, if you can believe it. It's a book about dealing with change. Much like the 4-Hour Workweek, it's a great reminder that truly timeless books have excellent titles, making them pop culture references for loads of people who never even plan to read the book. Success in publishing is hard, and so is retail, particularly when there are such disruptive forces at play. SPAR's cheese has been moved, literally. In fact, it's now being delivered by someone else, usually riding a turquoise scooter. You see, SPAR's business was built around a footprint of convenience stores that included not just a great deli offering, but the ability for the store owner to customize the in-store assortment based on the surrounding community. Done right, a SPAR is a wonderful thing. Those who live near a great one will agree with this. But here's the problem. That lovely in-store assortment is then very hard to scale to a delivery model that sits across stores, as such a model, think 60/60 for example, depends on the ability to fulfill orders from basically any store. Oh, and that convenient positioning that we all know and love, where there's a friendly SPAR wherever you are. Now there's a friendly scooter making you use your hooter, and that scooter usually has a Checkers, Woolworths, or Pick and Pay logo on it. SPAR's historical competitive strengths are now its competitive weakness. They are miles behind the curve with SPAR to you, and this is a growth opportunity for them, but they certainly have a very long way to go. Unfortunately, being behind the curve is a feature of the SPAR model because the basics are not as basic as you might think. It definitely did not help that the group was so distracted with operations in foreign countries, resting on their laurels in South Africa and believing that their business would not be disrupted and nobody would move their cheese. The winds of change are blowing, which means that SPAR is now in the midst of a turnaround. I promise that Supernatural Stocks has not just become a turnarounds podcast despite the recent run of episodes. There are just a few of them on the local market, and they do create juicy opportunities. Like in most turnarounds, there's now a focus on getting the basics right. Remember the catastrophic SAP implementation that SPAR had at their KwaZulu-Natal distribution center? There's a great example for you of getting the basics horribly wrong. Another example is that value-added services is a largely untapped opportunity at SPAR, whereas the likes of Shoprite Group and Pick and Pay have put plenty of focus into margin-accretive products sold at the tills. The interim results for the 26 weeks to 28th March show just how much work needs to be done at SPAR. The Southern Africa business saw combined grocery and liquor wholesale revenue growth of just 1.1%. The wholesale number is the one that really counts for investors because SPAR's performance depends on underlying retailer loyalty. This is a unique feature of the model. SPAR franchisees are not obligated to buy from the holding company, so the store level performance is only part of the picture. If the holding company isn't price competitive or efficient to buy from, the store owner can just go and procure elsewhere. That SAP issue, it's the kind of thing that hurts retailer loyalty. But there are other growth drivers. Among the grocery retailers, SPAR is the only one that also has a dedicated DIY business in the form of Build It. This is a good or a bad thing depending on how you look at it, and frankly depending on how it performs, of course. In the latest number, it looks like a good thing, as Build It managed sales growth of 4.1%, and that's ahead of how the grocery business is doing. It does come after a disappointing period though, with a decrease in interest rates finally starting to unlock some growth there. They also follow a voluntary procurement model at Build It, so the listed company needs to keep delivering proper support to franchisees. Their biggest competitor in that space is Cashbuild. There are a couple of incredible slides in the Capital Markets Day presentation that really made me laugh. They show the store and sales growth of Cashbuild, but what makes them so funny is that SPAR actually blurred out the Cashbuild logo in the slide, even though it is so incredibly obvious that it's a picture of a Cashbuild store. It probably says something about the pharmacy market that the SPAR Health presentation included no such slides with blurred logos of major competitors. That market is a lot more fragmented than people think. Yes, Clicks and Dis-Chem may have commanding positions, but there are many independent pharmacies. This means that there's a great opportunity for wholesalers in this market, with Clicks and Dis-Chem fighting over that as well. Despite the obvious gorillas in the room, SPAR is managing to compete here. They acquired an initial stake in S-Base in 2017 and pushed hard into that market, supplying both unrelated independent pharmacies and SPAR pharmacies. So once again, SPAR acting here as the wholesaler. They think that the existing footprint of SPAR pharmacies can significantly more than double, creating a larger market for their wholesaler on a voluntary basis, of course. As always, they will need to keep delivering, literally. The old joke is that if you want loyalty, get a dog. As a passionate cat owner, I don't fully agree, but I will tell you that both dogs and cats are more loyal than SPAR's franchisees. And that's something that absolutely has to improve if the turnaround is going to be successful. If SPAR can increase the percentage of goods that franchisees are procuring from the wholesale holding company, then that listed company can significantly grow sales, even if the underlying stores are barely keeping up with inflation. To do this, they will need to add more value to the retailers and will need to ensure that nightmares like the SAP implementation never happen again. With the end in sight for the offshore headaches, leaving only the Irish business, which makes a meaningful profit, it does feel as though SPAR's management team is giving themselves a chance to actually deliver on their promises in the Southern African business. I must note, however, that this turnaround story has had a few starts and stops now. I do have a small long position in SPAR, one that is up 12% at the moment, but took far too long to get there. I do sometimes worry that perhaps I'm too spoilt by how good my local SPAR is, clouding my judgment of the overall group's ability to extract some value from here. As always, time will tell. What do you think? Is SPAR capable of recovering in a market where Pick n Pay is desperately trying to return to profitability, with ShopRite and Woolworths as the clear winners at the moment? Let me know in the comments. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.